Well, natural gas futures are losing ground as traders react to warmer weather forecasts and strong production data. Market participants have now rolled from the March 2026 contract into the April 2026 contract ahead of expiry, shifting focus to spring fundamentals. From a fundamental perspective, weather remains the primary driver. Forecasts call for above normal temperatures during the first week of March, reducing expected heating demand. Over the weekend, weather models briefly shifted colder, triggering buying when the market reopened Sunday. However, those models quickly reversed warmer, and prices sold off sharply. April futures dropped below the key $3 level and continue to trade there. The rapid shift from bullish to bearish sentiment confirms that the market is currently in a sell-the-rally mode. Aside from the sharp spike during Winter Storm Fern in late January, sellers have largely controlled price action since December. That spike forced shorts to cover aggressively, but once the storm premium faded, bearish pressure resumed. Concerns about softer demand and elevated output could keep prices under pressure in the near term. Production remains strong. Dry gas output is running at 113.7 billion cubic feet per day, up roughly 9% year over year. At the same time, the EIA projects average production around 110 billion cubic feet per day, compared to 108.8 billion cubic feet per day previously. Traders are watching supply closely because inventories remain in deficit. The key question is whether production during the spring shoulder season will be sufficient to rebuild storage ahead of summer cooling demand. The wildcard continues to be LNG. Feed gas flows to U.S. LNG export terminals reached 19.9 billion cubic feet per day on Monday, up 1.6% week over week. Strong LNG demand could tighten the balance later this year, particularly if export capacity expands as expected. In my view, LNG growth remains the primary structural bullish driver for 2026. As I have mentioned many times, when gas prices were trading above $4, the LNG narrative was clearly overestimated and largely priced in. Now the situation has flipped. With prices back under pressure, the market appears to be underestimating the impact of rising LNG demand. This imbalance in expectations suggests that an upside correction is becoming increasingly likely. From a technical standpoint, April futures are starting March in a clear downtrend. The key resistance level is the 50-day moving average near $3.15, close to yesterday's high. Unless prices break and hold above that level, rallies are likely to be sold. On the downside, there is a gap between $2.85 and $2.75 that could act as a magnet if selling continues. However, the market is becoming technically oversold. With prices below the $3 pivot area, value buyers may gradually step in, especially ahead of the anticipated increase in LNG exports in the coming months. If natural gas can stabilize and settle back above $2.85, we could see renewed buying interest, particularly if spring weather trends turn colder than currently forecast. Until then, momentum favors the bears, but oversold conditions suggest that a corrective bounce could emerge at any time. If you're looking for a more detailed breakdown of the market, consider joining the channel. Members get early access to new videos, so you can see the analysis before everyone else. Thanks for being here, see you in the next update.